In December 2003, officers at Bank of America's Milan office were shown a single-page document printed on the bank's own letterhead. It confirmed a cash balance of approximately 3.95 billion euros held by an entity called Bonlat Financing Corporation in an account in the Cayman Islands. The officers stated, flatly, that the letter was a forgery. The account did not exist, had never existed, and the bank had never issued the confirmation. Investigators later established that the document had been produced by passing a genuine Bank of America letterhead through a scanner and a fax machine, the reproduction deliberately softened to obscure the manipulation. The question this episode answers is structural. How does a single fabricated bank confirmation come to stand in for nearly $3 billion on the audited books of a publicly traded multinational? And how does that fabrication survive audit for years? The instrument at the center of the Parmalat collapse is not exotic. It is the bank confirmation. When an auditor examines a company's financial statements, cash is treated as the most verifiable asset on the balance sheet. Inventory can be miscounted. Receivables can be disputed. Goodwill can be argued. But cash held at a bank is confirmed directly with the bank through an independent request sent by the auditor to the financial institution, asking it to state the balance held on the client's behalf. This procedure is a foundation of the audit. The logic is that the bank is a disinterested third party with no incentive to misstate. The confirmation closes the loop. The auditor does not take the client's word for the cash. The auditor takes the bank's word. What made this control effective was the assumption of independence in the channel. The auditor sends the request. The bank replies directly to the auditor. The client never touches the document. If that chain holds, the confirmation is nearly unforgeable because the party with the motive to lie never handles the evidence. The SEC's enforcement record against Parmalat and its associated actors turns on a single structural fact. At Parmalat, that channel did not hold. The confirmation request and the confirmation reply both passed through the hands of the company. And once the company controlled both ends of the loop, the most verifiable asset on the balance sheet became the most fabricated. According to the SEC's complaint, filed in the United States District Court for the Southern District of New York in December 2003, and later resolved by consent, Parmalat used a network of nominally independent offshore entities to conceal debt and manufacture assets. The architecture can be reconstructed in steps. Step 1. The offshore repository. Parmalat established Bonlat Financing Corporation, a subsidiary incorporated in the Cayman Islands. Bonlat functioned as a catch-all. Fictitious assets that could not be sustained elsewhere in the group were parked on Bonlat's books. The SEC found that Bonlat carried the roughly €3.95 billion balance purportedly held at Bank of America. That balance did not exist. Step 2. The fabricated confirmation. Because Bonlat's audit required verification of the cash, a confirmation was needed. The SEC's complaint states that Parmalat personnel created the false confirmation using scanner and fax equipment to reproduce Bank of America letterhead. The document was then presented as though it had arrived through the independent audit channel. The forged letter did not merely misstate a number, it substituted for the entire third-party verification function. Step 3. The concealment of debt. The fictitious cash served a purpose beyond inflating assets. Parmalat had raised enormous sums in the debt markets, issuing bonds to investors across Europe and the United States. The SEC found that the company disguised the true scale of its borrowings. Reported debt was understated by billions of euros. The manufactured cash on Bonlat's books offset the real liabilities elsewhere in the group, producing a consolidated balance sheet that appeared solvent when the underlying entity was not. Step 4. The recycling of intercompany claims. The SEC's complaint describes the use of fictitious intercompany transactions and the repurchase of the company's own debt, recorded in ways that eliminated liabilities on paper, while the cash to extinguish them never moved. New overholding and related vehicles were used to route funds and obligations in circles. What this means structurally is that the group did not simply hide a single hole. It built a closed system of internal claims in which each fabricated asset was supported by another fabricated asset, and the entire structure rested on the Bonlat cash balance at its base. Step 5. The market financing that the fabrication sustained. Between the late 1990s and 2003, the SEC found Parmalat raised more than $5 billion from investors through bond and note offerings, some sold to US investors. The offering materials rested on financial statements that incorporated the fictitious assets and understated debt. Each new issuance required the appearance of financial health. The appearance required the Bonlat balance. The Bonlat balance required the forged confirmation. The org chart, drawn from memory, is a pyramid. Real debt at the top, fictitious offsetting assets in the middle, and a single scanned letterhead at the foundation. Why did this survive for years? The detection failure begins with the confirmation channel itself. The control assumes the auditor sends the request and the bank replies independently. The record establishes that at Parmalat, this independence was compromised. When the confirmation for the Bank of America balance was sought, the request and reply did not travel a clean third-party path. The document that came back was one the company had produced. For the control to have caught the fraud, the auditor would have had to obtain confirmation through a channel the company could not touch. That is precisely the vulnerability the confirmation procedure is designed to eliminate, and precisely the vulnerability that was exploited. There is a second structural failure in the audit rotation. Under Italian law at the time, audit firms rotated. Parmalat's primary audit engagement had passed from one firm to another, but Bonlat and certain offshore entities remained with a firm that continued to audit them after the main group audit had moved. The effect was to segregate the entities holding the fabricated assets under a separate audit, reducing the likelihood that a single auditor examining the consolidated whole would trace the fictitious cash to its source. The SEC and subsequent proceedings established that Grant Thornton's Italian affiliate audited Bonlat, and that the false Bank of America confirmation was accepted in that engagement. The structure exploited the seam between two audits. A third failure lies with the analysts and rating agencies. Parmalat was, on its reported figures, a company with substantial cash. Yet it continued to borrow aggressively. A company holding billions in cash that simultaneously issues billions in new debt presents an analytical anomaly. Why borrow at a cost when idle cash sits on the balance sheet? The record shows this pattern was visible in the public filings. The coexistence of large reported liquidity with large ongoing borrowing is the observable footprint of the fraud. For detection to have occurred earlier, someone in the verification chain would have had to treat that anomaly not as inefficiency, but as evidence that the cash was not real. The unraveling began with the debt the fabrication was meant to conceal. In late 2003, Parmalat faced a bond payment of approximately €150 million. For a company reporting billions in cash, this should have been routine. The company failed to make the payment cleanly, and the failure drew scrutiny to the liquidity that supposedly existed. Attention turned to the Bonlat account at Bank of America. The auditors, now examining the confirmation directly, sent an inquiry to Bank of America. In December 2003, Bank of America responded that the document was not authentic and that the account did not exist. That single response collapsed the base of the pyramid. Once the €3.95 billion balance was established as fictitious, every asset and offset that depended on it was exposed. The SEC filed its complaint in the Southern District of New York on December 29, 2003, charging Parmalat with securities fraud and alleging that the company had, in the words of the enforcement record, engaged in one of the largest and most brazen corporate financial frauds in history. Parmalat entered insolvency proceedings in Italy under extraordinary administration. The court-appointed administrator, Enrico Bondi, later pursued recovery actions. The SEC's action was resolved by consent. Parmalat, without admitting or denying the findings, agreed to a permanent injunction against future violations of the federal securities laws and to adopt governance reforms. Subsequent enforcement and litigation established the roles of individuals and of the auditing firms. The estimated shortfall between reported and actual finances was on the order of €14 billion. The gap between the pyramid on paper and the emptiness beneath it. What this case establishes is narrow and precise. The bank confirmation is effective only to the extent that the client cannot touch it. Its entire evidentiary value derives from the independence of the channel. When that channel is compromised, the confirmation does not merely become weak evidence. It becomes an instrument of the fraud, lending the auditor's credibility to a fabrication. The most verifiable asset on the balance sheet is verifiable only under an assumption that, once violated, inverts completely. The direct regulatory consequence followed. Audit standards for confirmations were tightened, placing greater emphasis on the auditor's control over the confirmation process and on independent verification of electronic and faxed responses, which are more easily fabricated than originals. Later guidance on external confirmations addressed precisely the vulnerability that Bonlat exposed. A confirmation that passes through the client's hands confirms nothing. The finding of this review is that a fraud of nearly $3 billion did not require a sophisticated instrument. It required a scanner, a fax machine, and a channel that no one insisted on closing.